At the end of the last lesson, we have mentioned that the theoretical forward price, predicted by the formula learned previously, may not agree with the true price observed from the market. This is mainly due to the irregular market movements of the underlying commodity. Taking the oil market as an example, it is very likely to see that the spot oil price being higher than its future price. A very extreme reason could be that there is an ongoing war currently, and the market is experiencing a severe shortage of oil. In this case, holding the oil physically is more profitable than having a forward contract on hand. Thus, the forward price would be lower than that predicted by the formula we learned earlier. To account for this so-called negative holding cost, here comes the concept of convenience yield. Let Y be the convenience yield per period. For simplicity, we assume it is a constant. However, it could be period dependent, or in fact, they could be modeled as a stochastic variable with respect to time. Then, the forward price formula can be adjusted as follows. Note that the negative sign here reflects the nature of the convenience yield being a negative holding cost. A wider picture of the spot price and the prices at various future time of certain assets can be observed from the forward curve of the asset. The curve is the plot of the forward prices of the underlying assets versus the corresponding different maturities. And the point where the maturity is 0 corresponds to the current spot price. Due to the time value of money, it is natural to have an upward sloping curve. That is, the further into the futures, the higher the forward price is. Thus, if the curve is upward sloping, the forward market is said to be normal, and otherwise, the market is inverted. Another commonly used terminology to describe a forward market is contango versus normal backwardation. Different from the previous graph, where the horizontal axis represents the different maturities, here in this graph, the horizontal axis represents the evolution of time. The graph, therefore, shows that forward price must converge towards the spot price as we approach the contract maturity, no matter it starts higher or lower than the expected future spot price. Then, contango describes the market when the forward price is above the expected future spot price. That is, in a contango market, forward prices are falling over time. Whereas normal backwardation is when the forward price is below the expected future spot price. And thus, in a normal backwardation market, the forward prices are increasing. To end this section, we talk about the valuation of a forward contract. Suppose a forward contract for delivery at time T has a delivery price F0. This price was agreed at time 0. And suppose the current forward price of the underlying asset is Ft. Then, the value of the long position of this forward contract is Ft minus F0 times the discount factor from time small t to capital T. And we always use the small letter f to denote the value of any derivative contract. To prove this formula, let's construct two portfolios. Portfolio A, holding a long position of a forward contract with delivery price Ft maturing at time T, and a cash amount of Ft minus F0 times the discount factor from small t to capital T. And for portfolio B, holding a long position of a forward contract with delivery price F0 maturing also at time T. Then at maturity, the value of portfolio A consists of two parts. The value of the forward contract with delivery price Ft is St minus Ft, and the value of the cash amount grows to Ft minus F0. Adding the two together, we get St minus F0. And the value of portfolio B is the value of the forward contract with delivery price F0, that is St minus F0. Since both portfolios have the same value at time T, they must have the same value at the current time. Therefore, the current value of the forward contract with delivery price F0, that is, the current value of portfolio B, is equal to the current value of portfolio A, which consists of two parts: the value of the forward contract with delivery price Ft, the value of the cash amount. And note that the value of the forward contract with delivery price Ft is 0 at the current time. We thus obtained the value of the forward contract with delivery price F0. Here is an example of a forward contract on a non-dividend paying stock with delivery price $24 and currently has 6 months to maturity. Given the risk-free rate of interest is 10% per annum with continuous compounding, and the current stock price is $25, what is the current value of this forward contract? First, we need to calculate the current forward price of the stock. Since the stock pays no dividend, its 6 months forward price is equal to the current price divided by the 6 months discount factor. Then, by the formula derived earlier, the value of this forward contract is the difference of the current forward price and the delivery price of the stock times the 6 months discount factor. In this example, the forward contract is on a non-dividend paying stock. Now let's briefly remark the cases when the underlying asset earns income. In the case when the asset has predictable income whose present value is I, based on the forward price formula derived in the last lesson, we have Ft times the discount factor from time small t to capital T is equal to St minus I. And similar for the case when the asset pays continuous dividend. Up to now, we have finished the section on forward contracts. From next lesson, we will start the section on futures contracts.